Ever feel like money market funds are this big mystery? Like you hear about them everywhere, right? But what are they really about?
Yeah, it's easy to get lost in the jargon.
Totally. So today, we're diving deep into how these things actually tick. We'll break down the math, make it crystal clear, so you can make your money work for you.
Sounds good.
We're drawing insights from Debt-Free Living 254 today. They have this cool analogy comparing money market funds to a piggy bank that grows.
I like that. A piggy bank that grows. That's a good one.
Right, it makes it relatable. But instead of just holding your cash, it's out there earning interest, like it's got a little side hustle going on.
Exactly. It's the whole idea of making your money work for you.
And they give us a sample calculation. So you start with, let's throw a number out there, 5,000. Their example uses a 15% annual interest rate. Now, I know what you're thinking.
That's pretty high.
Exactly. Don't get too excited.
Yeah, interest rates are constantly changing. Don't get stuck on the number itself. Look for consistency over time.
That's such a crucial point. Don't just chase the highest rate, right? Look for something sustainable.
Absolutely. Look at the long-term performance of a fund.
Okay, but let's say we're working with this 15% example for now. That translates to, drumroll please, about 62.50 in interest every month. Hold on. There's a catch.
There's always a catch.
There is, isn't there? And that catch, my friend, is...
Taxes.
Of course.
Uncle Sam wants his share. It's called withholding tax.
Right.
Basically, the government takes a bit of your interest up front.
Right. Always got to factor that in.
It's different for everyone, depending on your tax bracket and all that.
Absolutely. Now, another thing Debt-Free Living 204 brings up is withdrawals. Say you're taking out your interest every month. Your initial 5,000, it just hangs out there, right?
It keeps earning on that same amount.
Yep. But if you pull out everything, it's like hitting the reset button.
Right. Your next interest payment is calculated on whatever's left, not that original amount.
Which brings us to this whole other fascinating concept.
Compound interest.
Exactly. Basically, your money starts earning interest on interest. It's like a snowball effect.
Yeah, over time, even small amounts can really add up.
For sure. But we'll save that deep dive for another day because you know what else we got to talk about?
Gotta talk about fees. Those pesky fees.
Debt-Free Living 254 reminds us to watch out for those sneaky fees. They can really eat into your returns. Look for something called an expense ratio.
Lower is better.
Exactly. Lower is always better when it comes to expense ratios. Let's say Fund A has a slightly higher interest rate.
Okay.
Right?
Okay.
But their fees are 1%. And then there's Fund B, slightly lower rate, but only charges 0.25%.
Yeah.
In the long run, that difference can have a huge impact.
Makes a big difference.
Huge. So to sum it all up, money market funds, they can be a fantastic tool, but the devil is in the details.
It really is.
Understanding those interest rates, those pesky fees, taxes, it's all crucial to making informed decisions about your money.
Makes you think, right? It's not just about finance, this idea of earning on what you already have. It applies to so many things in life. Like, think about your skills, your knowledge. The more you put in, the more you get back.
That's a powerful thought.
It is, isn't it? We can apply that to all areas of our lives.
I love that. Food for thought.
Definitely.
Well, on that note, that's a wrap on our money market deep dive.
Until next time.